It makes sense that when the Fed pumps in credit, interest rates get pushed to artificially low levels, then the banks chicken out, the Fed chickens out, it jacks up short-term rates, and then the recession starts. And then that's why once the recession's imminent, the Fed can see that, right? They can see that employment's getting weaker, consumer spending's getting weaker, and so forth. And so the various indicators that the Fed relies on, and they start cutting short rates again. Because they're saying, oh, now the danger is a recession. Before we hiked rates to try to get price inflation under control, but now it looks like the economy's entering a soft patch and we better start cutting. And so then that's why the yield curve uninverts.
Welcome to InFi, the future of finance.
Hey everybody, welcome back to the InFi podcast. This episode, I thought I would revisit the issue of the yield curve. I've had several people over the last few weeks messaging me and saying, hey Bob, do you know the yield curve is uninverted and do you want to say anything about that? So I thought, sure, that's kind of my beat. I've been talking about this for a while now, so why don't we go ahead and do that? So big picture, the news hook is that in December of 2024, the yield curve, and specifically, unless I say otherwise on this issue, I always mean the difference between the spread between the 10-year Treasury security and the 3-month U.S. Treasury security. All right, some people look at the spread between the 10-year and the 2-year. That's another popular one to check. But the research, when I did this for like an academic paper, and my co-author was Ryan Griggs, by the way, who was a student at Texas Tech when I was down there. The research indicated that, at least as of when we did that paper a few years ago, the most predictive of the possible indicators you could look at was the 10-year and the 3 months. So that's what I always mean, like I say, unless I say otherwise. So the news hook is that has been inverted, or had been, I should say, inverted for a long time. Inverting meaning that the yield on the 3-month was higher than on the 10-year. But then in December of 2024, it finally uninverted, meaning at long last, the yield on the 3-month had fallen below the yield on the 10-year. I waited a little bit, incidentally, before recording an episode on this topic, just to make sure the markets didn't violently move the other way and that it was just a temporary thing. But it looks like, it's here to stay. So why don't I, in this episode, just sort of give an update on all of this and what do I think it means as far as the economic outlook for the United States. So the reason this matters, the reason people care about the yield curve, is that it does seem to have an uncanny ability to, quote, predict or signal an impending recession. All right, so if I flash up here on the screen, and by the way, I'm drawing on an accompanying blog post at the Infineo website. So right now, again, you're listening to the InFi episode number 71. I'll put links to everything, of course, if you want to go look this stuff up. But the images you're going to be seeing if you're watching the video version of this episode are going to be drawn from the blog post that will be linked as well. So what you're seeing right here, FRED is the St. Louis Federal Reserve's online database. It's very convenient. It has access to all sorts of official government data and also market data. And it's got very convenient charting capabilities. And so that's why you may see like a lot of bloggers and things and economic analysts will be flashing FRED charts all the time to you, because it is, number one, somewhat authoritative data in the sense that it comes from the official sources, but also, two, you can manipulate it at least within certain parameters and present it the way you want to. So that's why this is such a popular medium. If you've seen a lot of people flashing, like, what the heck is this FRED chart? That's what it is. Okay, so right now what we're looking at is FRED has an inbuilt data series called the 10-year Treasury constant maturity minus 3-month Treasury constant maturity. All right, so this is apples to apples in terms of how are they quoting these different market yields and these particular government bonds. And so you can see that gap. So again, this is just showing the spread. So this is the yield in the 10-year minus the 3-month. And as this chart shows you, going back to the early 1980s, whenever there's a recession, and that's what's indicated by the horizontal bars on this chart, those are recession years, according to the National Bureau of Economic Research's official clocking of them. And you can see that every time there's a recession, if you look shortly beforehand, the yield curve inverted, meaning it went below that zero line, meaning the 10-year minus the 3-month became negative. Or that's just the fancy way of saying the yield on the 3-month was higher than the yield on the 10-year. Okay? And also the mirror image of that statement is true. Anytime the yield curve inverted, there soon followed a recession. Okay, so there weren't any false negatives or false positives, at least going back to the early 80s. And in fact, here I'll flash a different chart at you. This chart goes back to the early 1960s, and you can see that same pattern holds up. I will say, however, here, the reason it doesn't quite seem to work in this, in particular, if you look before the recession in the early 90s, it looks like the yield curve didn't quite invert. That blue line doesn't quite get below the black horizontal zero line. But that's just an anomaly. It really did invert. You use the right figures. What's going on here is Fred does not have that 10-year minus the 3-month. That particular series only went back to the 80s. That's what I showed you the first time. I didn't show you this longer history. Here, I'm just forcing it. I'm taking two different data sets. One's the 10-year yields and one's the 3-month. And I'm making Fred subtract them. So I'm sort of like manually doing this calculation. And that's why they're not quite apples to apples. That like the way they're quoted and stuff, like one's an investment basis and one is a discount basis. You know what I mean? So that's why they don't quite work. And it looks like it didn't quite work there. I will say though, even though using the quote real data, the false positive in the mid 1960s is real. That you'll see there, the yield curve did invert and there wasn't technically a recession. But even there, it was a near miss. That the economy did slow down in that period. It's just the official statisticians didn't call it an outright recession. It was just a slowdown in GDP growth. Okay, so even there, it's still the pattern held up that when the yield curve inverted, soon thereafter, economic growth stalled. It just didn't actually flip to be negative, and so they didn't call it a recession. Okay, so I'm just showing you here that this pattern goes back at least to the 1960s. And so again, what is the pattern? You can see that it seems like when the yield curve goes negative or inverts, then soon after there's a recession. So that's why, I'll flip back to the more recent example here. When the yield curve this time around, this cycle inverted back in late 2022, that's when the yield on the 3-month first was above the yield on the 10-year. This time around, people were concerned. And then given my work in this area, I was warning people like, hey, this looks like it's signaling that there's going to be a recession. And then I would give updates. So let me, at this point, explain, if you go back and dig up some of my earlier either podcast episodes or I wrote some posts on it and so forth and radio interviews and whatnot during this period, I'm sure it came up occasionally. I'm sure that I gave time frames in terms of, well, hey, based on historical precedent, we should expect a recession to begin in such and such time frame. And I was premature, right? In other words, if you go back and look at when I was talking about, hey, the yield curve's inverted, that's not a good signal historically. Think about this. I'm sure that I said probably the recession will begin, and thus far I would have been wrong, right? That in other words, it didn't start when I said it should have started by now. So let me just explain for what it's worth, just so I want to acknowledge that. I don't want to be coy with you folks, but also I just want to show you what's going on here is you'll notice looking at this recent graph here of the 10-year minus the 3-month, the inversion that we just saw was by far the longest, right? Even looking at the longer range one, going back to the 60s, you can see that the horizontal gap of how long was that blue line below the black bar, this most recent episode blows out of the water any of the prior occurrences. And so that's partly what happened is until this time around, this cycle, until the yield curve uninverted, until, in terms of these charts, until that blue line went back above the black line, we didn't know when that was going to happen, right? That when I was making those earlier comments and then trying to give people some guidance, we were still in the region when the yield curve was inverted. And so all I really had to work with was looking at historical patterns and saying, well, usually when we're at this point, the recession kicks in. And I gave like a range, in terms of looking backwards. Once we're in the inverted period, how long until the recession kicks in? And I gave a range in terms of the shortest lag was such and such back in this year. And then the longest lag was such and such back in this year. So this time around, let's say the pattern does hold up still, and I think it will, that, 10 years from now, people looking back at this kind of chart, I think they're going to see that, oh yeah, in late 2022 and then through 2023 and 2024, the yield curve was inverted and uninverted right at the end there of 2024. And then I think there is going to be a recession that's going to occur in the near future compared to what I'm talking right now. And that people down the road looking back will see that. And they'll say, yep, same pattern as it always was. But what they will say is, wow, that was a particularly long inversion period there. And so if you tried to say, when did the recession kick in relative to the start of the inversion initially, this cycle we're going through right now is going to be by far the longest delay. All right. So that's, take that for what it's worth. So let me give you the punchline here. I know many of you are busy. And then after I give you the punchline, I'll fill in some more of the theory behind this. So it's not just us blindly looking at curves, but there is logic behind it. And there is a reason that I personally think this indicator is a valid one. But to give you the news you can use, if instead of clocking it in terms of either when the yield curve initially inverted or once it looked like it bottomed out and then it had started the rebound, because that's another obvious point you could say from that inflection point is the yield curve, that spread kept going more and more negative, but then once it peaked, the negativity of it and flipped around and it started moving back towards an uninversion, that's another one. But instead of doing that, what if now that we've got the yield curve is back to being uninverted in terms of these charts, now that blue line is back above the horizontal black line, we can ask, okay, historically, how long from the uninversion point going forward before the recession officially is said to have kicked in? Okay, so that if that's what the question is now, I can just run through this pretty quickly for you. For the last recession, so the one right before COVID, the yield curve uninverted that time in October of 2019. And then technically the recession on this chart, at least they're showing it starting in February 2020. You can remember, I think the lockdowns actually started in March. Okay, so if you're using that lag there, that's 4 to 5 months between when the yield curve uninverted that time and then when the recession officially began, is 4 to 5 months. The prior recession, right? So going into the 2008 financial crisis and the recession that followed it, in that time, the yield curve uninverted in June of 2007. In the actual recession, by the way, this might surprise you unless you follow this stuff. The way the NBER, the National Bureau of Economic Research, the way they classify when the recessions begin, they're saying that one actually began in December of 2007. Right? So the financial crisis, Lehman going down and all that stuff and AIG getting bailed out, that didn't happen until September of 2008. But in terms of ex post, the government statisticians looking at the various indicators, because there's a lag on a lot of this data that comes in. So a lot of times the economy is technically in recession, but the bean counters don't know it until down the road, until the data come in and they can say, oh, looks like, according to our judgment, the recession began at such and such month. Okay, but anyway, for that particular cycle, again, the yield curve uninverted in June of 2007. The recession began 6 months later in December of 2007. Right, so there was a 6-month lag. Going back to the recession, the so-called dot-com recession, there the yield curve uninverted in January of 2001. The recession officially is said to have begun in March of 2001. So that was only a lag of 2 months for that one. And then this last one I'll do here, for the recession that happened in the early George H.W. Bush administration, there the yield curve uninverted in 1989, and then the recession began in July of 1990. So that was a longer lag of about 10 months. Okay, so again, of the last 4 recessions, the lag between when did the yield curve go back to being, quote, normal and upward sloping, and then when now, based on when we officially say the recession began, what was that delay? It was 4 to 5 months, 6 months, 2 months, and 10 months. All right, so if history is to be repeated, that would mean eventually when they look back at this and they say, when did this next recession begin? You would think it would happen in 2025. And let me be clear, like I've been saying throughout when I do these commentaries on these things, that doesn't necessarily mean that the government officials who are in charge of this stuff will officially declare, oh yeah, we're in a recession this year. It could be that in 2026, like in the spring, looking backwards, they say, hey, you know what? It looks like the economy tipped into recession back in November of 2025 or something. That's a possibility as well. Because again, in real time, for example, the so-called Great Recession that began in December of 2007, people at the time, it wasn't like the Wall Street Journal as of January of 2008 was saying we're in a recession right now. That wasn't known for sure. Okay. So again, what I'm saying is down the road, looking backwards, if this pattern is to be repeated, you would expect that this recession will officially have said to begun in calendar 2025 at some point. Now, again, though, there's a caveat. We have to ask, well, is this time going to be different? Because, again, this was the longest inversion period. And so does that mean that it will take longer for it to kick in? So there, it's hard to say, the honest answer is we don't know, right? Because it's human beings that are involved here and they have free will. And so this isn't just like predicting what a bunch of molecules are going to do in a petri dish. But beyond that, it's difficult to glean a pattern in terms of like when you look at these prior ones, you could say, oh, the longer the inversion period, did that mean there was a longer delay or a shorter delay? And it doesn't necessarily look like there's any obvious pattern that's jumping out from that. For what it's worth, I feel as if the most relevant benchmark to compare our current situation to is the economy going, when the housing bubble had been inflated and then was deflating, right? So going into the Great Recession. If I had to pick and say the situation of our economy now, what's it closest to, I would pick that one, but that's just a judgment call. And so again, for there, that lag was about 6 months for what that's worth. Okay, so now that I've given you that update, let me just remind you folks as to, what's the theoretical basis for this. So I won't take too long in this, but I do want to just remind people as to why should we think that this indicator means something. So I am a member of the so-called Austrian School of Economics. And before I even heard about this historical pattern of the yield curve, quote, predicting or signaling an impending recession, I adhered to the theory of the boom-bust cycle that Ludwig von Mises had developed. He originally developed it in 1912, and then Friedrich Hayek, who was one of Mises' leading disciples, I guess you could call him. He wasn't like literally his student, but Hayek was a big proponent. He had attended Mises' seminar, and then Hayek thought Mises' explanation of the business cycle was the best one he had heard, and then Hayek himself did a lot of work in that area. I'll link, folks, if you want to see this spelled out more, on a separate podcast that I do for the Mises Institute. I recently walked through lectures that Hayek had given at the London School of Economics in the early 1930s. So Lionel Robbins at the time, so you remember the 1930s, the world is in the throes of the Great Depression. Lionel Robbins was at the London School of Economics, and he knew that this guy Friedrich Hayek was like the leading critic of John Maynard Keynes. Right, so Keynes's general theory didn't come out till 1936, but Keynes had been a big gun in the economics profession before that. And Hayek was like one of the leading critics of the Keynesian approach. And in particular, when it came to business cycles, the Austrians said basically the opposite of what the Keynesians said. And so Lionel Robbins invited Hayek to come to the London School to give some lectures on this, again, in the early 30s, to make sure, hey, let's give this other viewpoint a hearing, because if these Austrians are right, what the central banks and governments are doing in response to this crisis is the exact wrong thing. All right, so if you're curious and want to see more, I'm just going to give you a quick taste of it in this episode here at the InFi podcast. But if you want to see a more academic, drawn-out explanation of the theory behind the Mises-Hayek explanation of the business cycle, I will link in the show notes page to that recent podcast episode I did where I summarized what Hayek said in those public lectures. Okay, but for our purposes here, big picture, what Mises/Hayek argued was that in market economies, prices serve a function, and in particular, interest rates help to coordinate long-term plans. And specifically, when entrepreneurs are directing scarce resources, not just labor hours from the workers, but also natural resource factors like iron ore and stuff like that, and the available farmland and so forth, that there's a choice they can make. They can devote these productive factors to making goods intended for immediate consumption, like cranking out radios sets for households and nylon stockings for women and so forth. Or these resources can be used to produce capital goods, which aren't directly useful to the consumers, but only aid in production down the road. for example, if you've got a factory, it makes a difference in the grand scheme if what the factory is cranking out are television sets versus gears that can be used to make other machines with. You see how that matters? So you could just call both of them output, but it makes a difference in terms of the structure of the capital system, in terms of how the economy is built. It matters the time distribution of these resources, okay? And generally speaking, in the Austrian tradition, the idea is the longer the processes into which these resources are invested, the more physically productive they are, right? So if you take worker hours, and you've got 10 guys and they show up and they work 8-hour shifts, if you take those 80 man hours of labor per shift and you put them into projects involving, making gears and belts and circuit boards and stuff that are going to be used to make other machinery and so on, in the long run, when you do the accounting, those worker hours are producing more total stuff in terms of what, the individual amount of the end product that you want to devote to them or to assign to them and say they're responsible for that. Okay. So if the consumers are patient and they're willing to delay gratification, the economy can shift away from making immediately gratifying goods like ice cream cones and movies and TV sets, and can shift to making things that are, going to make the workers more productive down the road, so that way down the road, you'll get more ice cream cones and TV sets and so on, because the workers have more tools to work with. That's the idea. So there's a trade-off, and the idea is, in a sense, the economy has the technological ability to reduce the amount of consumption goods flowing out of the pipeline in the near future in order to have more consumption flowing out of the pipeline in the more distant future. And so you got to coordinate that, right? That the technological realities have to line up with the consumer's subjective preferences to say, hey, do you want one ice cream cone now, or do you want 2 ice cream cones available in 2 years? That's not an engineering question. That's a value question for the consumer to say. Just, subjectively, what's the trade-off in terms of your evaluation, right? There's objective factors involved in what's the trade-off, what are the numbers, but in terms of what's better, what's preferable, that's ultimately a subjective question that each consumer has to answer, okay? So in the Austrian tradition, it's interest rates that help ensure that entrepreneurs, when they're making the actual decisions as to what project should we start building an apartment complex here? Should we build a factory? Should we build a grocery store? So forth. Those decisions are guided in part by interest rates. And the idea is that the more patient and longer term focused the households are, the more of the current income that they save and lend out, or, deposit with the bank, and then the bank lends it out and so forth. That helps regulate those intertemporal decisions. Okay. So big picture, if the households, it's what's called, if their time preference falls, if they become more patient, if they're willing to defer gratification, they save a higher fraction of their income. They spend less on going out to restaurants and buying TVs and fancy cars. In the present, they save more. That leads to the supply of loanable funds being higher, interest rates fall, and that gives a green light to entrepreneurs to start longer projects. Okay, so everything all meshes. The problem now comes in, what if the reason the interest rate falls isn't because the households have delayed gratification and they're spending less on ice cream cones and TV sets and Ferraris, but just because the banks, perhaps in conjunction with the central bank, are just creating new money electronically and flooding the credit markets with it. And that's why the interest rate falls. Well, that's still going to give a green light to the entrepreneurs to start longer term projects, but the households haven't cut back on their actual consumption. And so now there's a mismatch. The entrepreneurs are trying to elongate the structure of production, but the consumers don't want to postpone or delay their gratification to make that physically possible, to make all these projects all compatible with the underlying physical realities and the technological trade-offs. Okay, so that's the basic story that Mises told and Hayek elaborated upon to say this is what happens in market economies and why we have these periodic boom-bust cycles, that the banking system floods the market with cheap credit that's artificially cheap, that pushes interest rates down to artificially low levels. It gives the appearance of prosperity. It gives the appearance of there being more saving available than there really is. So there's a general upswing in business. Businesses are hiring workers to try to, start these longer projects. But meanwhile, the diners and the movie theaters aren't laying people off because people are still going out to eat and going to the movies as much as they always were. And so now the workers' wages get bid up because there's all these different people competing for their hours. And so everybody feels wealthy, but it's based on an illusion. And then at some point, reality rears its ugly head. The banks chicken out, they tighten up on their credit, or the central bank sees measures of price inflation rising too rapidly and they chicken out and they start tightening. And then based on the new information, the entrepreneurs realize, ooh, we were too aggressive. They start scaling back, they start laying off workers, and then what we call the recession starts. Okay, so that was the basic Austrian story. And so now I'm saying when I became aware of this empirical regularity with the yield curve, it occurred to me that, oh, this kind of makes sense, right? So I never saw Mises or Hayek talking about the yield curve per se. In fact, I don't know if this pattern held up like in the 1800s or whatever, but certainly post-World War II, that pattern makes sense from an Austrian business cycle theory perspective. And so specifically what I'll do here is I'll decompose, instead of just looking at the 10-year minus the 3 months, let me show you the two series overlaid on top of each other, right? So now in this diagram, you're looking at the 10-year treasury yield is the blue line and the 3-month is the red line. And so you can see, and this just goes back to the mid-90s. So you can see going into the three recessions that are on the screen here, what actually happens is that in the quote normal period, when the yield curve is upward sloping, it's mostly that the 3-month rate gets pushed way down. And then when the yield curve inverts, what typically happens, it's that the 3-month yield gets jacked up pretty fast and then shoots temporarily above the blue line. And then they both come down as you go into the recession. All right. And so I think that that makes a lot, this lines up with the Austrian story that in the boom period, which we think of as, oh, that's quote normal with an upward sloping yield curve where the 10-year yield is higher than the 3-month. What's really going on there, it's not that the 10-year is unusually high. No, it's that the 3-month, the short-term rate is unusually low. And that fits in with not just the Austrian view, but general economists in general think that the central bank has more control over short-term rates, that the central bank just pumps in liquidity. That's going to push down short-term rates more than it will push down long-term rates. And one reason for that, in case you're curious, is if the Fed creates a boatload of new money and goes out into the market and just starts buying treasuries, they can certainly raise the price of short-term treasuries by doing that. But the longer-term treasuries we're talking about, the more another effect has to be taken into account, namely that the Fed just pumped in all this money that's probably going to lead to rising consumer prices. And so investors take that into account. And so for them to lend their money to buy 10-year treasuries now, because the Fed's pumped in all this extra cash, they might build in a higher inflation premium than they did before the announcement of the new monetary policy. Whereas for shorter term treasuries, like a 3-month T-bill, even if the Fed pumps in a bunch of money, it's not that eggs are going to go up to $20 next Thursday, right? There's like a lag between pumping in the money and when it works its way through the system and starts pushing up consumer prices, at least typically, and within modest amounts at least. Okay, so that's part of the reason that, again, if the Fed's dumping in a bunch of money, it can push down short-term yields a lot, whereas it's harder for the Fed to push down 10-year and 20-year and 30-year yields. Okay, so anyway, if that's true, then this pattern that we see in terms of the graph we're looking at right now with the blue and the red line and showing that the yield on the 10-year and the 3-month, you can see that, yes, in the so-called boom periods, that red line gets pushed down to artificially low levels. And then when the boom comes to an end, what happens? Because the Fed starts tightening and you see that 3-month yield shoot up. And then the reason the inversion occurs again is because it overshoots a little bit for a temporary period. And then they both start coming down. So what I think happened now, if we just look on this chart at the right-hand side, for our more recent episode, you could see that, that red line, when COVID hit, the red line went down very quickly to basically zero. And then it shot way up in early 2022, it began. And that was when the Fed started aggressively hiking interest rates because people were worried about, we had the worst consumer price inflation at that point that we had had in 40 years. And then that red line shot way above the blue line. And that's why the yield curve was inverted for so long. And why did that happen? Why did that persist? It's because for whatever reason, the economy didn't collapse. Right. So, and if you remember, in terms of the commentary, people were warning and they were saying, we don't want the Fed to aggressively hike rates. We don't want the Fed to hike rates too much because that's going to tip the economy back into recession, right? So that's what like guys like Paul Krugman were warning and saying, no, this inflation is just transitory. It's the supply bottlenecks from COVID lockdowns and things like that. We don't want the Fed to hike rates too aggressively because then that will stifle aggregate demand and tip us back into recession. Yeah, that's what Krugman and people like him were arguing in 2021 and all through 2022. All right, but for whatever reason, that didn't happen, right? The Fed didn't listen to Krugman. It did aggressively hike interest rates, and people were surprised, right? The yield curve inverted. Guys like me were saying, there's going to be a recession. And we kept looking like we were wrong because, the economy's doing fine. And lots of people, both the Keynesians and the Austrian types, the Chicago school, we were all, or not all, but many of us were taken aback because, normally you would have thought such an aggressive Fed rate hike would have led to a recession earlier than it happened. So my point here is to say the reason I think the yield curve remained inverted for so long on this cycle, much longer than any previous episode, is just that for whatever reason, and I'm not speculating as to what that reason is, but normally when I get the short-term rates that aggressively, the economy goes into recession, right? And so the Fed sees that coming and they start cutting a rate to try to get ahead of it. Right. So with this stuff, it's not that a curve on a graph causes a recession. Obviously, there's underlying things going on. That's why I was trying to tie this back to the long-term or more historical Mises-Hayek business cycle theory, that I'm saying these curves do summarize some of that story, I think, pretty nicely, that it makes sense that when the Fed pumps in credit, interest rates get pushed to artificially low levels, then the banks chicken out, the Fed chickens out, it jacks up short-term rates, and then the recession starts. And then that's why once the recession's imminent, the Fed can see that, right? They can see that employment's getting weaker, consumer spending's getting weaker, and so forth. And so the various indicators that the Fed relies on, and they start cutting short rates again. Because they're saying, now the danger is a recession. Before we hiked rates to try to get price inflation under control, but now it looks like the economy's entering a soft patch and we better start cutting. And so then that's why the yield curve uninverts, is once the Fed sees a recession coming and then they start cutting short rates. Okay, so I'm just saying this last cycle, the Fed was allowed to keep rates at those high levels for longer than they normally are allowed to get away with, just because the economy was still showing signs of resilience. Okay, so that's kind of the theory behind it. And so again, this time around, I still believe in the Austrian theory of the business cycle. I think the Federal Reserve, both in terms of the rounds of QE after the financial crisis and then what they did in response to COVID, was to completely distort the credit markets. The Fed created boatloads of money, far more than it had done in any earlier cycle, pushing interest rates down to unprecedentedly low levels. And in terms of what the Fed did with its balance sheet, again, it's not even close to what it had done in earlier cycles. And so if you think the Fed just creating trillions of dollars electronically and basically through a shell game, lending it to the government and giving it to investment banks that had speculated poorly on the housing market by buying mortgage-backed securities, if you don't think that's a good thing, and I don't, it's hard to see why that would be good for the economy, right? So I think that the Fed has set us up for a hard crash. But again, just this cycle is so much different from previous ones. I hesitate to say it in terms of, I'm sure it's going to happen by this date because things have been different this time around. But still, nonetheless, the reason I personally like this indicator of the yield curve and its inversion is because it dovetails so nicely with what I think is the best explanation of the business cycle that I've seen from an economic school of thought. Okay, so of course, I will monitor this stuff and tell you folks if things change or if I give updates. But until that point, I would say, given my understanding of the business cycle and the way I'm interpreting these data, I think down the road, looking back, economic historians will say the next recession began in calendar 2025. Thanks everybody for your attention. We'll see you next time.